Welcome to the Money Vikings podcast, where we conquer financial freedom. Join Greg, Jerry, and Bob as they discuss everything investing and personal finance. The Money Vikings podcast is hosted by three dads who are doing what they can each day to burn down debt and build wealth. Learn the path to true wealth. Their podcast and website, moneyvikings.com, is a treasure trove of ideas. So without further ado, here they are, the Money Vikings.
Will 2022 be as batshit crazy as 2020 to 2021? Probably. Vikings podcast number 64, everybody. Jerry, Bob, how you doing?
Very good. Doing good, man. Doing good.
64. Wow. And I'm 64.
Yeah, isn't that cool? 64.
Yeah. Yeah.
We've been rocking out the podcast. I love it. This is so cool.
It's through all the batshitness too.
I thought I'd get you on that one, Bob.
Did he really say that?
I'm sorry, guys. I think that we're all feeling it right now. Like I'm feeling like everybody wants to move on from the pandemic, but there's a little bit of, there's a little bit of uneasiness out there in the world. You know what I'm talking about?
I feel like I'm in a modern day episode of The Twilight Zone, actually. Just kind of where I roll.
I think that's a good way of putting it. So on the show today, we are going to talk about our top 22 investments for 2022. And, this has to be taken with a grain of salt. I want to say this up front. Okay. We know that every year brings all kinds of shenanigans, and especially in this day and age, because you're going to have, we know that COVID's going to continue to mutate. We know we're going to get boosters. We know that inflation is going to, give us a bumpy ride. We know that assets are highly valued. We know that other shenanigans are going to happen that, are just going to knock the, but at the end of the day, investing goes on, right? As we talk about, life goes on. People are out and about, they're doing things, but there's going to be kind of disruptions. We'll talk a little bit about that today. Did want to do a shout out to anyone who wants to join Premium for Christmas. We have a special promo code, so join us for 50% off the first month. You can try Money Vikings Premium. Join us in Discord, get all of our premium services, talk to Bob, Jerry, and I anytime you want. Especially late at night. No, just kidding.
Oh yeah, middle of dinner.
Articles,
not late at night. We need to sleep.
Hot trades, all kinds of stuff. Yeah, guides,
tutorials, newsletters packed full of information. All of our latest trades, options trades, Bob's charting strategies, etc. But the code is XMAS50. So XMAS50. We'll get you that 50% off. So XMAS50, type that in when you sign up for Premium, and we'll look forward to seeing you in the new year. So, yeah. Bob, what else? YouTube channel? You want to mention the YouTube channel?
Yeah, I mean it's starting to. We're finally getting to that point of shifting gears, doing a lot of educational stuff, guides, how-tos, what is like what recently, did one on trend, like what is trend, covered calls. We're going to polish that a little bit and have some other ones coming. We're going to do some real estate stuff. It's going to be some what is it, kind of how-to stuff. And so that's growing as well.
Very cool.
Nice.
Well, Jerry, should we launch into the 22 for 2022? What do you think?
Yeah, and that's a catchy title, by the way. I love it.
I'm on.
I don't know what you're going to do next year.
I know. Yeah.
Oh,
I know. It's just going to get really crazy in the year 2050. 50 for 50.
Yeah.
No.
Yeah.
So So I initially put this list together. I don't know if you guys think I'm crazy or not, but let me give you a sense of my theme going into 22 because of all the quote unquote batshit stuff that I just mentioned. Because I just think there's a lot of uneasiness out there. Okay, high valuations. We're going to have some volatility. I feel there's kind of a languishing, people are just not quite sure where things are going. Where's inflation going? Where's the COVID going? All this kind of stuff. So my theme is simple. It's quality. It's also cash cows. I'm trying to focus on companies that actually, I'm trying to deleverage away from the companies that are kind of the unicorns that, hey, they'll someday turn a profit. Yeah. I would like to go into 2022 investing in things that are making a lot of money. Okay.
Yeah.
Yeah. You know what I mean? Has a resiliency, can withstand, COVID mutation shocks, which are coming, can take inflation on the chin, all these kind of things that are going to happen. The other idea I wanted to think about was preserving capital. I think preserving capital, beating inflation, booking some decent returns, sometimes that's a win. We got to remember,
sure,
it's not right. It's not always, the 1,000% swing is great. Okay. It's a lot of fun, but you're going to have years, I think, investing where, hey, you've preserved your capital and you've beaten inflation, and you got to pat yourself on the back for that. That's not a bad thing. So that's where I'm at. I mean, approach I'm taking, I want to be forthright with people. It doesn't mean I'm not doing a stuff like the crypto and the ARK funds and all that stuff, but I'm going to try to make the core to be about these 22. So
would you say that the theme is generally overall value as opposed to growth?
Yeah, that's a good way of putting it. It probably is a bit of a shift to value because I the value plays have not, they haven't done that well, and they've kind of been forgotten for the more, the more growth and the kind of the tech stuff that's the hot commodity. I don't know. I guess Jerry, I call it quality is what I always go back to. I'm always thinking about the word quality. I'm like, is this, you know what I mean? Not to say that a company like, Uber or Lyft or something like that isn't quality, but they just, like, these companies that, they're unicorns. They have a long way to go before being a Pfizer, or being a Berkshire, where they're just tried and true companies that are pumping out money.
I think we're going to see some emerging things next year as well. As we start to evolve into the kind of EV space, the kind of a newer energy market, solar and stuff like that, clean energy, I think we're going to probably start seeing some stuff that's going to kind of prevail. We're going to see some new winners come out of the game, and we'll see a lot of the big names probably start piquing interest and investing themselves in some of those companies as well. I think that 2022 into 2023, we're going to see some of that.
Well, Bob, I think you're on track with what Kathy Wood says, because she's believing that it's a nice setup. I know, got to tell you this, but yeah, she's seeing it. So that's kind of where I'm torn.
Because I mean, think about it. The way that these companies really take advantage of a situation is when they don't have to put up the capital to develop something or grow in a certain space or create some sort of value add for something that they're already doing. When they don't have to put up the capital to get it started, somebody else is doing that for them. That's just going to help boost them and launch them into a new area. So, and I think a lot of that's coming.
So, I got it. Yeah. Number one on this list is a tried and true. And all I got to say, Bob, you as a charting guy, look at the chart. It's our VDADX. Okay. The ETF version.
Thanks, Dad.
The ETF version is VIG, or I think it's VYM for the high yield dividend aristocrats. So basically it's the Vanguard Dividend Aristocratic Fund. You just look at the chart, it just slowly goes up. It's just it's quality companies that steadily rise in value and spin off company back to investors. You've got your Microsoft, you got your Chase, your United Health, your J&J, your Procter & Gamble. So I don't know. I'm gonna keep, because it's reliable. It does.
It's up 18% this year, so it's nothing to shy away from.
Look at that. Good. Yeah.
It had looking at it on like on a daily. Friday was just weird. Anyways, it was the fourth witching of the year, so we got that out of the way. But it dropped almost 2%. So it is in a little bit of a pullback right now. It is the end of the year. personally, I would say that maybe this is something that needs to um, be kind of beginning of 2022. But I want to see how this plays out because it is looking possible a little pullback might be coming here soon. Just a heads up.
And that's, they do that. It's fine.
They do. Stocks don't
Just
always
remember
go
the
up.
dad is forever.
The dad is forever.
The dad is forever. Thanks, Dad.
The second one I got on here is a little bit of mixing it up a little more than the good old reliable dad there, but it's the ticker is Qual, QUAL. It's iShares USA Quality. So this is my theme about going to quality, right? Because if we're gonna have a rocky ride with COVID, if we're gonna have a rocky ride with a potential this or that disruption. This has the likes of Costco, BlackRock, MasterCard, NVIDIA, but it tries to suss out quality, right, and resiliency in these companies. So it's a place you'd want to be if you're looking at a bumpy ride. Again, we're not, you guys know this more than anybody, and a lot of our members know this. We're not in the same market we were in, a year and a half. It's just rocket fuel every day, right?
Right.
I mean, that was a rare event. You had a big plunge of COVID, and then you were basically on rocket fuel for 7 months.
I think what you bring up a good point, Greg, is that I think we are going to start slowly, especially as the Fed, they've mentioned doing the 3 hikes, the interest rate hikes next year. We're going to slowly start seeing the market, I think, in a way, post-COVID normalize. Right? I don't think it's going to be the same necessarily as pre-COVID because there's a lot of retail, a lot of new skin in the game, but I think we're going to start seeing a normalization of trend, and it's not going to be like what it was when COVID first hit. So,
because I feel like a lot of the investors that got into the market for the first time over the last 2 years since COVID, they came in during the meme stock and the post-COVID, rocket fuel. And I don't know if they know that that's not normal.
And that's, and you get a lot of people jumping in. They're like, why wasn't I doing this 10 years ago? Right. It's like, well, it wasn't like this it wasn't like this 2.5 years ago.
No.
So I think it's,
So.
Well, I'm looking at Qual on the TradingView. I can't complain. It's even up more than big, 22% for the year. 22% for the year. It did go below the 50 EMA, but if it can get below the 21, it's well above the 200, so that's healthy.
Nice.
But as long as it can keep kind of chugging along, I think it's a good one to look at. And you said that's Costco, and it's got a few other big names in there.
It does. Yeah.
Nice.
Next one I think you guys are familiar with. We put it in the newsletter a while ago. And there's so I do want to tell the audience, I'm not saying that. So first of all, we don't give investing advice. Everyone knows that. We're not telling you to buy these funds at all or anything like that. I'm just telling you what I'm doing and what I'm thinking. That's all we're telling you. But the next one, we did talk about, it's UTF is the ticker, Steers Infrastructure Closed-End Fund. And this is basically to capture that huge once-in-a-generation infrastructure boom that's coming to theaters soon, as well as The Matrix. Which
yes.
There it is.
I love it.
Matrix 4. But anyway, the bottom line here is you've got the likes of, with this one, you've got Next Year Energy, you've got Enbridge, you've got American Tower, you have Canadian Railway, Southern Company. Again, very strong infrastructure plays. How much money is going to be pumped into infrastructure over the next 5-6 years? I mean, a ton.
Yeah. Technical term, a ton.
I mean, it was over $1 trillion, wasn't it?
Right.
I mean, wasn't it 1 point? I can't remember. 1.5 trillion, whatever.
Yeah.
So,
this one also has a 6.78 dividend yield, which is amazing.
Man, yeah.
This one's been ranging since April, kind of like IWM, right? It's been doing this ranging.
Yeah.
But it does have a possibility in the next few months here.
We'll see
some nice breakouts.
Yeah.
I mean, the other strategy is do everything opposite of.
Oh yeah.
And basically sometimes that works.
Let's roll some dice. Let's see how that goes.
So
I
everyone
mean, don't you guys?
buy puts on it?
Yeah.
I mean,
the
don't
whole
you
thing
guys
is to
feel?
hodl and to the moon. I mean, that's just what everything does. So yeah.
I mean, do you guys feel that way sometimes? You're like, just do
I
the opposite of what?
the thing is, like, I think we have pretty sound plays and investments that we do, and when I do the opposite of what you see on the talking heads on like CNBC and stuff like that, I tend to do better when I'm contrarian to their view. But I feel like we're pretty sound in what we do.
I think so. I mean, you guys know that what I'm talking about today is meant for like long-term investing, right?
Mm-hmm.
The other
True
one, so
investing.
the next one, and just so the audience knows, I'm not going to bore you with all 22. You can join premium or you can check out our site. But anyway, trying to give some of the themes going into 22. So the next one I'm going to continue on with, guys, is and I know you guys are aware of this, but you know, I do have exposure to some of the ESG funds. So for those of you who don't know this, you know, these companies are screened for what's called environmental, social, and governance, sort of welfare and health. Okay, they are. Think of it this way: it stays away from the things like big tobacco. It stays away from labor in other countries. You know, it stays away from companies that are doing extreme degradation, you know, to the environment for the sake of a buck, you know. And so to me, when I look at the writing on the wall, it just seems that, you know, having ESG exposure is the future. I mean, younger generations of consumers, younger generations of investors. I mean, I shouldn't just say younger generations, people. I mean, people, I think if they had a choice, if they can make money off of something that's responsibly sourced and doing bad things in the world, you know, like child labor or giving people diseases, I mean, I think they're going to choose the investment that is not doing those things. I mean, I would. I mean, if you know, I would totally do that.
Yeah.
So I just think that's something to look at. There's ESGU and ESGV. We know there's a ton of these. But anyway, I think that's just another theme that's going to continue on.
Yeah, absolutely.
So the next one, you guys are going to have to. So I don't know what you guys think about this one. So this one was a little bit of a wild card. Have you guys followed this Crane Shares Global Carbon Offset ETF?
I was in and out of it a couple weeks ago. I saw it was starting to move, break out, a lot of positive sentiment on it. So I bought a little just to kind of monitor it, and then I sold for small profit. But yeah, I haven't really been involved other than that, just as kind of a scalp. But I'd be interested. It looks like it got decimated last week, but maybe there is a future in carbon credits. I think this ETF is a wrapper for the futures, kind of like oil and natural gas. KRBN, that's the one you're talking about?
Yeah.
It's not, you don't think it has anything to do with the crypto space?
No.
Okay.
No, it's Crane Shares Global Carbon Offset. So here's what, and yeah, Jerry, I think you actually introduced me to it, and what actually got me on the list to begin with, because I admit this one is a bit risky and is a little bit out there. But what I was reading about it is that it could be considered almost the most non-correlated asset that you could think of against the market. And so that's a really good thing, because you always talk about that, like having some exposure to non-correlated assets makes sense sometimes. So I don't know. I was thinking maybe going into 2022 could be a good move, right?
Yeah, and I think the idea with these is that companies purchase them to offset their carbon emissions, right? That's what they do. It's sort of like a credit that you can purchase if you have a data center in it, or a warehouse, and it's producing, you know, X number of tons of CO2 emissions. You can buy this thing or invest in the future to sort of offset your carbon footprint.
Yeah, that's my understanding.
And they're tradable. They're new derivatives. They're tradable now.
So it's a little out there, but I don't know.
But it's
interesting. Yeah, interesting. Okay.
You and then scale up if you think it's take off.
So that's what I'm thinking. So the next one, guys, are want to talk about some REITs. So I'm reading that REITs are supposed to do pretty well next year. Quality REITs, of course. They've had a really good year in general. And even with interest rates interest rates rising, there's a few that can do well, I think, in that environment.
Now, Greg, elaborate on that, because you and I had an offline conversation about this, because I had said because of interest rates going up, you're going to see house prices go down, which means mortgage interest rates are going to go up as well. So, but you said that's
basically it's this. The interest rates would go up because of inflation.
Right.
Okay.
That real estate
typically does well in inflationary environments. The sort of the cost of the loans depreciates, the rents rise. A lot of these companies have locked in very low interest rates. And then sometimes the rents are tied to CPI. So even if rates increase or inflation increases, the rents go up. So a lot of them do well. And what I'm reading is that the forecasters are saying that they could still continue to see some good performance next year. I picked a few that are now, an investor, of course, can do a basket of REITs like VNQ. You can do the Vanguard Real Estate Fund, and you can get a plethora of awesome real estate. So the first one, I've talked about it before, medical property. This is a way to be recession proof, in my opinion. No matter what happens in the economy, human bodies and minds require healthcare. Hospitals and clinics, will continue to increase revenue. Some of their leases are tied to CPI and inflation. So that means the rental proceeds would increase. And then with medical properties trust, you have a 5% yield. So that's not bad. Next one people are quite familiar with is Realty Income. I know Jerry. But
the secret is out. I mean,
Realty Income is just one of the best REITs around. They grow this. They own this crazy portfolio of things that can withstand anything. They own, Dollar Trees, Walmarts, Home Depots, 7-Elevens, Kroger's, Walgreens, right?
I love driving around with my kids pointing out all my properties.
Love that.
I own that. I own 2 of those.
Hey man, they
pay you monthly.
You feel like the landlord. That is so cool.
Awesome.
Well, they're also moving into European markets, so I think there's a lot of growth in there.
Here's one that people need to keep, I think, on their minds too. Now it's probably a little bit high priced, but Crown Castle. These are the companies like American Tower that own, thousands and thousands of cell tower sites. Okay, and as you get 5G, all that stuff, you get the infrastructure spending in there. You have a lot of future growth. Now, admittedly, these are highly valued. They're great companies with tons of cash flow. Next one I'll mention.
Looking at the just a comment on these as I'm kind of looking through on the charts as you're mentioning. So CCI, Crown Castle International, it's a REIT that owns American Tower. That's in it.
So American Tower and Crown Castle, they just do the same thing.
Yeah, but VNQ, the Vanguard Real Estate Fund, has them all in it.
Okay. Yeah, because this one did really well for the year. It beat the S&P 500 year to date, looks like, on a relative basis by about 5 points. So it's up 30% for the year, 26% year to date. The dividend is, drum roll, please. Yeah, only 2.92. 2.92.
Well, it's healthy. It's healthy. Yeah, it's not 5, but it's healthy. Yeah. So that's one to consider. I don't know. The other one is along the lines of Medical Properties Trust. It's Universal Health Realty Income, UHT. Same idea as MPW. Probably a better value. 35 years of dividend growth, recession-proof business. I don't know.
It's hard to beat, guys.
It's hard to beat.
Yeah.
Next one is, I know you guys have heard of this one. These guys own Amazon warehouse, 500 industrial property buildings across 40 states.
That's crazy.
Wow. Oh, it's just,
it beats the S&P 500 as well. That's like my guideline for a lot of these things.
Your litmus,
continue to do fine.
Yeah.
Okay, the next one is Berkshire B, Papa B, and Mungie Pants.
Yes.
Bob, what do you think?
Oh yeah. So here's the thing.
Oh yeah, I had some See's candy today.
Yeah. So here's my thing. Burke has done really well. Through everything going on. So Burke B, for just Burke B for the example, is with all the volatility, like looking at like an IWM-esque kind of formation, it's pretty much doing that, right? It's stayed in this range since May of this year, and it's kind of stayed in the range, which is not a bad thing. A lot of times seeing these ranges occur, it's a setup for it to start working higher at some point. Right now, a little hot, and I think it's working its way. It's trying to break out from that range. So I want to keep an eye on it because it's definitely showing signs that it's actually ready to start a breakout. But I'm looking at Burke B, man. It's getting hot. I think Mungie and Papa Buffett are doing it right. So it's looking good.
Yeah.
Yeah, they do. Coke in hand.
Verizon. Verizon. It's a value play.
Next one's which one?
Can you hear me now?
Oh, Verizon.
All right, Bob, take it away. What do you think about, we mentioned Verizon, what do you think about Google?
Google. Oh, man.
It's my favorite thing. It's my favorite thing.
I know, but here's the thing: is the fangs right now. Like, this. I think they're all on the edge of getting slapped and seeing the pullback. However, this is where it gets hard. Is that, I mean, you think Google is one of the owners of the internet essentially. So it's like, as we start going into 5G, as we start seeing infrastructure and expansion on bandwidth and all these things, it's like, dude, Google could. It's weird. I'm two-faced on this one. I feel like it's gonna go down with the other FANG stocks, but I also feel like because it has a lot of interest in infrastructure in other areas, and it's gonna go up, right?
That's what I'm saying.
It's just so weird, man.
It's done really well, and it's outperformed the S&P again. It's way above the 200 moving average. It's below the 50, but yeah, I don't know. I think I don't know if you'd want to jump in right here, but it's definitely something to watch for 2022.
Mm-hmm. Try to see what the trend shows.
Qualcomm.
Ooh,
Qualcomm?
I like Qualcomm. I do like Qualcomm.
Yeah.
Qualcomm's
probably fairly
another 5G.
valued. Probably fairly valued at the moment, but I would say a future strength.
Yeah, because it just recently it has had a very monstrous run since October. They've had a huge run, and actually right now they appear to be doing a flag, like a bull flag. So it's kind of this one again, talking about ranging. It's kind of doing a ranging right now for kind of a technical cool off, but I don't see necessarily too much downside right now. Maybe looking around like 170-ish could be the bottom of this, but it's kind of ranging, looking like it could have some pep in its step in the near future here.
So here's the last one we're going to mention for this show. And this one I think you'll like, Bob. So RVP, Retractable Technologies. I think it's a hidden gem in plain sight. Okay. I think I'm looking to it 27% upside, maybe even doubling. They make the syringes, they make the IV catheters.
Yeah.
There's a lot of syringes being used to get all those vaccines out, man.
To get all those chips in your system.
There you go. Jeez, come on.
Sorry guys, I had to go there.
So it was up around 22, and now it's $7.15 per share, down 33% year to date.
Mm-hmm.
Wow.
But it's interesting because I don't know. It could be on a downwards wedge actually, and it possibly could be showing signs of a breakout.
Yeah, I mean, if you think that the trends, the technicals show something is changing, then Perhaps, yeah. I mean, it seems like a no-brainer, right? With vaccines and syringes, but the chart is not looking so hot right now.
Yeah.
Not to poo-poo all over your.
Okay, that's okay. No, that's okay.
poo-poo.
I like everything should be stress tested. That's good. That's good. So I don't know, guys. Those are some of the thoughts of what I'm having going. I think at the end of the day, you've got diversified portfolios, right, of different assets, hard assets, equities, maybe some bonds, maybe some cash. Depends on risk tolerance, right?
Yeah.
Yep.
So.
Yeah,
I'm still not sold on bonds, by the way. I don't know. Still not sold on them.
No one is right now, and I see why. Yeah. I see why. It makes sense.
Yeah.
Jerry,
well, especially, I mean, I was just gonna say on bonds. First thing on bonds, like if rates are going up, then that's going to make the values of the bonds we purchased today worth less, right?
Yeah.
Because inverse. But I was looking at I bonds, to be honest, inflationary bonds, and you can buy them on treasurydirect.gov, and they'll beat inflation by, I think, 1%. So you can get one. They're not that liquid. You're basically tying up to $10,000 per year on these things at 7%, and it's recalculated a few times a year.
Wow.
But it's something worth looking into.
I mean, do you remember though when 7% was return? I mean, if you got 7% a year, you'd be like, I'm the winner. I mean, that was like a big deal. But that's what I mean, you guys. Something happened the last couple of years with this meme stock stuff.
Yeah.
Well, people's expectations got completely messed up, skewed, and also, I mean, you have to make at least 6% to beat inflation. So if you're not even making 6, you're getting negative.
There's no point being
returns.
in the market.
So this is just an alternative to cash that is not liquid as cash. I mean, you could take it out, but you've got some penalties. So it's just something worth looking into. You're allowed to do up to $10,000 per year. So you could do $20,000 if you wanted to do some before the year ends. You've got about 10 days left, and then you could do more. If you want to do that, then you don't have to worry about your money devaluing to inflation, but you're not going to get any alpha. You'll just have, it's basically like me buying Amazon at the beginning of last year. Basically met inflation. A couple others that I just wanted to mention I'm looking at. Gold I've been in for a while, and I know everybody says gold is dead, go to Bitcoin. That's where everybody's going, but I don't know. I still feel like it's a nice small percent of my portfolio.
We were looking at what was it, GDX, Jerry? That was
yeah, we did some long calls on GDX. Those didn't work out, but my long gold is still I got some for my kids, and just kind of watching it and hanging out for a few years, seeing how it does.
Classic. It's a classic.
The other ones I'm looking at haven't really done so well this year at all is the psychedelics and the cannabis plays. There's MJ, there's PSY. So I mean, if you think like kind of like RVP that it's been so beat up that it's going to eventually turn around, there's some good deals there in psychedelics and cannabis.
I think though that I think that's definitely the future though, right? I for sure I think those are good things to have because that is the future of therapeutics and even just to say it, medicine. Because there are proven results in studies when used properly. Psychedelics and cannabis actually have those therapeutic curative properties. So it's only a matter of time before we start talking about the legalization on a federal level of marijuana, cannabis, and used appropriatly, right?
Right.
It's only a matter of time, and I think like just having a sprinkle
with a doctor,
right? But having a sprinkle of it in your portfolio, I don't think it's a bad thing. I think it's.
But you're on the Bob, as far as Gary brought up, I'm having.
And this is when stuff is like that, right? And it's gone down and it's low and it's unpopular.
I mean,
that is the time to buy it, right? So
Yeah.
So psychedelics and PSY is an ETF that I'm in. I mean, it's done really poorly, but maybe it'll pick up. Maybe I don't know. And then a couple others like non-related to those is uranium. I'm in some. We did some URA trades this year. I think the forecast for uranium in the next few years is looking positive.
Yeah.
I also have some CCJ, a Canadian company that makes it. And then oil too. I've been playing oil with iron condors. That's more of a neutral play. But if there's things that aren't moving around that you think are just going to stagnate and be range bound for another 6 months, have at it and sell some iron condors against them. I'd love to hear what some of our listeners are looking at in that respect. Yeah.
I actually want to look. I want to see REI. That was the one from way earlier this year that was showing signs of this massive breakout, and it did it, and then all of a sudden it just got I don't know,
destroyed.
It just got annihilated and
CLO'd.
Yeah, it was showing signs like it was gonna. Yeah, it got CLO'd. It was showing signs it was gonna go, and then it right. It's our new term, but
it got CLO'd.
It's it did, but it's I don't know. It's weird. It's a really weird one right now. Like it's showing like it could bounce again, but it's kind of was a letdown. A lot of the technicals were showing that it was going to go, and it was an energy oil play, and it just got guttered.
It looks like it's kind of near the bottom of the range. I mean, it could probably go a few more dollars to like $1.83, $1.80 maybe, but then after that, I mean, and unfortunately, it is below all three moving averages too. But, I don't know. Maybe if it can break the 200, might be a good confirmation to get back into it. I don't know. Yeah,
could be. Just play the direction on it.
Yeah.
But.
Well, guys, any parting thoughts for our audience?
Merry Christmas.
Merry Christmas, man. Yeah, we're getting into it. So Merry Christmas, everybody. I'm taking it each week for the end of the year. We're going to be watching out for the Santa Claus rally.
Right.
Whatever the market's going to do this next week, I have a feeling we're going to see more downtrend, but so I'm just going to take it day at a time and try to find the opportunities, but I'm going to remain very, very liquid for right now in the trading account, and then see what we have going into 2022. See if we have the miracle of January, the January rally coming. We'll see.
We will see.
We will see.
No one knows.
No one knows, man. Day by day.
No one knows. That's what's so exciting about this.
Yeah. Have your security and then just play it day by day, and that's it.
Yeah.
All right. Well, join our premium. You guys have the code.
Xmas
50. Is it again?
Xmas 50.
Xmas 50.
Xmas 50. Do it.
Yeah.
I love it.
All right,
guys.
Talk
with y'all soon.
Merry Christmas. Be safe. Be good to each other. Take care.
Take care.
Cheers.